Thank you for joining us today with our series of webinars to discuss online capital formation or securities crowdfunding. My name is Andrew Dix, and I am the publisher of Crowdfund Insider. We're a digital publication that covers the crowdfunding industry as well as other forms of fintech. Today, we're going to be talking about the crowdfunding industry as it is now, looking at the pipeline, what's going on today, and what the expectations are going forward. This is always a good topic to discuss and review. It impacts everybody, issuers, investors, platforms, and we're lucky enough to have three individuals here that are experts in the industry. Two of them are OGs, regular suspects, and I'm going to ask each of you to introduce yourself and tell us a little bit about what you're doing today. And I'm going to start with you, Woody.
Thank you, Andrew. It is great to be here with everyone. Woodie Neiss with Crowdfund Capital Advisors. Worked on the framework for regulation crowdfunding, did a lot of the lobbying for that, and was at the White House for the bill signing ceremony. Launched Crowdfund Capital Advisors that sort of sits at the intersection of three themes that we see right now. One is data for the industry, and that's through our data arm called CClear. Another one is secondary trading. So Guard is our fintech sort of compliance technology solution for that. And then D3VC is our venture arm that invests in investment crowdfunding offerings.
Awesome. Thank you, Woody. Sara, once again.
Hey. Hi, Sara Hanks, founder of Crowdcheck Inc. and Crowdcheck Law. Between the two of them, we provide a wide range of legal, compliance, diligence, and disclosure services. We've been in the industry since the very beginning, together with Woody.
Awesome. Stormer, this is the first time you've joined us in this session, and I thank you for being here. Stormer, you're with Dalmore Group, a broker dealer. Maybe you can tell us a little bit about what Dalmore does and what you do.
Yeah, absolutely, Andrew. Thank you so much for having me, and great to be connected with everyone on the call as well. My name is Stormer Santana. I'm the director of sales at Dalmore Group. Dalmore's been a broker dealer for 20 years now, hyper-focused in online fundraising. Specifically under Regulation A+, D, and CF. We've had the opportunity to onboard over 1,000 issuers, many of those being the Reg A type of issuers or perpetual issuers as well. Where Dalmore supports is everything from broker-dealer compliance all the way to technology. So actually putting investment solutions on your website, allowing you to raise capital through these great exemptions and tools directly on location. So really powering the issuer to take control of their fundraising journey and enjoy the opportunity of what Reg CF A+ and D can offer in an online perspective. Really excited to be here with the group and looking forward to the conversation.
Yeah, thank you very much, Stormer. So again, we're very fortunate to have two OGs, Woody and Sara. They have been here from the beginning. They were really, foundational to the entire industry, and they bring a wealth of knowledge and information to the broader ecosystem of online capital formation. And thank you, Stormer, for being here because you guys are doing some interesting things, and I always love to hear about what Dalmore is doing in a boots in the ground environment. So I wanted to start with the type of activity that we're seeing today for online capital formation, for the full stack of exemptions. I don't always get to drill down into this and have a good understanding of where things are going. We're lucky that we have Woody here because one of the things he does is he tracks the information for Reg CF. And we were speaking recently, and Woody kind of gave me some updated information on April as how it compares to the month prior and how it compares to last year. So I thought maybe we just start with you, Woody, where you can actually give us some hard data on activity in the marketplace.
Sure. So March and April were two of the strongest months in terms of capital commitments for the industry to date. April had $73.3 million committed. That was up from $62.5 million last year. but down from 84 million in March. So there's definitely a lot more capital coming into the marketplace. One of the things that you need to keep in mind, though, is when the amount shifted from 1 million to 5 million in 2021 as to what issuers can raise, we started to see a lot of these parallel offerings, the 506C type of offering come in, and we're starting to see more money being committed in the parallel side. So if you look at the amounts that are committed just through Reg CF, it's still strong months. It was 45 million in March and almost 50 million in April. But you can see that we're getting a good sizable chunk of capital coming in from the parallel side. So I think that's a positive sign that more of these angels or VCs that are syndicating deals are doing deals on these platforms and bringing in the crowd. But we've also seen some pressure in the industry in terms of the number of offerings. There's just been, fewer offerings. I think there's 98 for April. It was 98 last year. It was 144 in March. So there's been a decline. And I think there's just a disconnect between the number of checks written, the amount of capital that's being committed, and issuer sentiment in terms of looking at this as a viable way to go out and raise capital. So, I could go on forever, but I'll leave it at that right now.
Okay, well, it's a good starting point for us. So we're going to flip over to Stormer here because, again, you guys are processing deals all the time. You're reviewing. I don't know what your approval rate is for the full stack of exemptions, but there's some you approve, I'm certain, and probably a good number that you say you don't want to handle. From a broker-dealer platform perspective, what type of deal activity are you seeing right now? What is Dalmore, looking at?
Yeah, absolutely. I think it's, and Woodie, kind of a great stage in terms of what we're seeing, the cyclicalities of the market. I mentioned at Dalmore, we work with a plethora of issuers, everything from that seed stage startup that's using Reg CF to maybe raise their first $500 to $1 million, to the Reg A offerings that are looking to raise $50, $75 million, and then some of the larger issuers leveraging Reg D, sometimes concurrently, and there can be unique strategies there as well. Across the board, what we're seeing is increased appetite from more sophisticated issuers that have typically gravitated towards the traditional path of maybe a Reg D offering done online through high net worth, close networks and institutions, looking at exemptions like Reg CF and Reg A to complement their existing capital stack. So I would say that's a strong, overwhelming theme of, the perspective of an issuer raising significant capital through Reg D, but recognizing the opportunity in the retail audience, maybe selecting smaller checks in volume with the concept of building community. Now, we've been heavily focused and a very active player in Reg A issuers. Reg A, being a tool that we look at as, perhaps a vehicle for operating capital, or perhaps a structure for series offerings or perpetual issuers. So the ability to offer a fund, a REIT, and some form of offering that can pay, dividends or yields, in the future. So with that, when these more sophisticated issuers are coming to us, having conversations, looking at Dalmore as kind of that guiding light to say, how do we navigate these exemptions? How do we go to the crowd? There's Reg A, but oftentimes Reg CF becomes a topic of conversation, given the go-to-market and the cost associated with an A+, anywhere from 3 to 6 months.
So what type of activity are you seeing in CF and A and D today? Is it mostly A or is it CF? Is one side slowing down or?
No, I would say there's increased appetite for A with the idea of starting with a CF. Because when you look at the go-to-market strategy, an A can cost significant amounts of upfront capital and a launch period of 3 to 6 months. Where you look at a CF, in theory, you could have an offering launched in 6 weeks with a fraction of the costs. Now you're throttled at $5 million in capacity to raise under regulation crowdfunding, but at least it gives you that opportunity to start, go to market, build community, and then jump into the regulation A exemption. So, I think across the board, we are seeing increased appetite, as Woodie mentioned, but it's navigating that go-to-market strategy is something that we're supporting with.
Yeah, I think it's really interesting that you're saying that you're seeing more issuers that are doing Reg D, Reg CF, or more sophisticated issuers that maybe somebody who has done private placements in the past, but now they say they want to bring in a different type of investor. Is that accurate?
That's exactly right. That's exactly right. And we see that with real estate significantly, right? You know, the real estate being one. Yeah, go ahead.
So is that something where they just want to broaden the access to capital for the offering? Is it something that is strategic and they want to build more customers or users? Is it because they see it as a path for cheaper capital, or is it all the above? Why is that?
I think every issuer has their unique strategy for leveraging exemptions. I would say, though, there's an overwhelming theme across the board of all of the above. Accessing unique capital, creating community, and perhaps a different way or different cost of capital going to the retail audience. And so this is more so of a community building exercise and complementing a CF and an A alongside maybe a strategic round with a D. Now I'm speaking more towards the perpetual issuer that's leveraging these larger exemptions, but even, you know, Reg CF, very, very strong demand for Reg CF. However, the challenge is go to market. And so maybe that's where test the waters comes into the equation. How do I test? How do I validate my community before jumping in and raising capital? And so that's something we're helping issuers navigate.
Okay. When they do, like, say, a CFD side-by-side offering, a parallel offering, are the terms the same always, sometimes, or never? Because I know that some people, they want to structure it differently because it's a smaller investor. I mean, it makes sense. I mean, what do you guys see? What are you seeing today?
Case by case, I would say if it's an operating offering, meaning, you know, we're raising capital for our Series A, typically the terms are going to be unique, you know, for the D and for the CF. Now we have perpetual issuers that are leveraging A+ and D concurrently that may have different lockup structures and different yields based on that lockup. So it's a debt offering perhaps, and we're offering, you know, a 9 to 13% yield based on a certain lockup structure. So it's usually unique structures for a D and a concurrent offering, but it could be case by case. If you know you have a really strong appetite from strategics and you know, accredited investors, you know, you're going to set appropriate terms under that Reg D and use CF or A as that bolt-on strategy to build community and to create awareness and start, you know, building an audience around your existing offering and then hopefully future offerings as well.
Okay. All right. I want to jump over. I want Sara jump in, because Sara, at least in the past, until recently, you'd be looking at a lot of documents coming through. You guys were probably the most prolific provider of legal services to the Reg A industry. Correct me if I'm wrong. And in all honesty, when I would look at a Reg A document, you know, one of the few who would review the information, and I saw that Crowdcheck's name was on there, in my mind, you guys know what you're doing, and this is going to be a clean doc, right? But at the same time, I know that you look or speak to many different issuers, and so you're seeing kind of the good and the bad and the in-between. We were speaking recently the other day, you said that you saw the industry as holding and morphing. And I thought that was an interesting way to describe it. So what are you seeing?
Yeah, in terms of volumes, I think, you know, what we are seeing is not a huge growth in volumes across the various exemptions, but as I think it was Stormer who said, we are seeing a lot more issuers coming into the 506C. I mean, that's a huge growth, whether it's combined with the Reg CF or not. And that's the sort of holding. When you look at pure numbers, you know, as Woodie said, bigger checks, smaller number of issuers. But the morphing part is, I think, the most interesting, because, you know, they're from the beginning. Some of the companies in the very early days of Reg A were absolutely terrible. They were just, you know, this guy who had an idea and he thought, well, he'd just throw a terrible document at the SEC and see whether anybody was interested. We don't see those guys anymore. On the other hand, what we are seeing is much more complex structures, people coming in and saying, well, I want to do this weird thing. And that's possibly doable with Reg A. It is difficult with Reg CF to do really complex things in the structure where you are reaching out to the retail investor and trying to explain to them what's going on. And one thing that Stormer raised was the different valuation, the different price ranges that, or bonuses, or the structures that you can have if you have side by side. One of the issues that we've seen from the very beginning is one category of Reg A offerings that we never anticipated was the hard assets, interests in hard assets, whether it's hard assets like sneakers and racehorses, or soft assets like music royalties or the like. When you have those things, which were totally unanticipated by the industry as a whole, and certainly by the regulators, getting a differential pricing structure is incredibly difficult. You can't do bonuses if you are doing bits of a racehorse. It just does not work from a mathematical point of view. And so dealing with the whole move towards more complex structures and more diverse underlying assets has been quite a challenge for us.
So you're saying that there's not a lot more, they're just more complex right now. And
A lot of
really
it, yeah.
hard.
But
Yeah, and some of them are very weird, and some of them will not listen to lawyers and consultants.
Imagine that.
We go back to keep it simple, stupid, because you've got to be able to explain what it is you're selling. You don't just have to sell, you have to explain what it is. Now, if it's a share, it's fine. If it's a share of a racehorse, fine. But going beyond, more complex than that, you've got to get your story straight.
To support what Sara's saying too, when you look at the data of the issuers themselves and when they've incorporated dates, the revenues over time and all that stuff, the demographic of these companies is grossly different from 2016 to 2024. And I think that plays out along the entire industry. Just within Reg CF, I know in 2016, 65% of the issuers when the industry launched were under 3 years old, and they had revenues, they barely had revenues. But now 65% of them are over 3 years old, and the average revenues are, up to $2 million. So, and that can be skewed by outliers, of course, but that's the point. We're starting to see a lot more sophisticated companies come into the space, and because they're more sophisticated, they've got different needs. And I think that sort of pushes the boundaries of, particularly in Reg CF, which is a structure, like this is how we're going to do it, keep it simple. To what Sara's saying, people are like, well, I sort of want to do this as well. And we've seen people be creative, particularly with the people that are using venture funds via Reg CF. That was never the case to do a venture fund through Reg CF. You have to, the money needs to go into a business, but the management company is a business. So you can actually sell off a piece of your venture fund that way and raise capital and launch a venture fund. But so it's, people are creative in what they're trying to accomplish.
Well, I think creativity can be a good thing. It can also be a challenging thing. I think the encouraging thing, at least what I'm from hearing, is that we're seeing more mature issuers enter the marketplace, which means there's probably a better chance that they'll be successful in not only raising their money, but executing on their business plan. And I think that's good for everybody. Woodie, as you put it out back in 2016, most of these were, pre-revenue startups. And I think the creators of the Jobs Act, originally that's what we're thinking of. But of course, we're a creative, innovative country, and companies see opportunity in leveraging these new exemptions. And here we are today, getting better, hopefully. So there's a lot more we could talk about there, but I wanted to ask all of you a question about technology, the use of technology, and is this process becoming more efficient? And I know Dalmore, you talk about making the investment as simple as e-commerce, obviously always compliant with adhering to all the regulations. I would think that today, for funding portals, broker dealers, support firms like a Crowdcheck, things have improved because not only do you have the experience, but you also have, honed the technology. Your tech stack is hardened. And I'm going to start with you, Sara. Is that an accurate statement? Is Crowdcheck better today than it was back in 2016?
Yeah, almost certainly, because I think at some point we have an internal manual which answers all of the questions about everything. And it's now over 200 pages long, and it does not include all of the templates and so forth that we have. Because what we're trying to do is do the same thing the same way every single time. Issuers understand it, investors understand it, the regulators understand it. And so having addressed most of the questions, we now see recurring questions, and we can go, okay, just go to page 181, there's your answer. And if only the SEC would take our manual and publish that as part of their
They should,
compliance
right?
and disclosure. Yeah, I have actually offered that to them.
Good luck.
Yeah, we are in a place now where we've seen most of the weird stuff that can happen, and I say most because there's always something new every single day. Internally, externally, we are so much more efficient than we were, and we also understand all of the other players better as well. I mean, we work very, very closely with Dalmore. We know what the answer is. They know who to come to. Nobody has to sit there and think, I don't know what the answer is. And the answer to pretty much everything's on Crowdcheck blog anyway.
That's good. So let's go to Dalmore. Stormer.
Sure.
You're a broker dealer, which is different than a funding portal. You guys can do more things than a funding portal can do. You are a specialist in online capital formation, the full stack of exemptions, Reg D, 506C or B. You do everything. You're also tech forward. And in my discussions with you and with others at the company, it seems like you're always working on something new and improved features and functionality. From your perspective, is the process getting easier? Is it easier today at Dalmore than it was in 2023 and 2022? And could you share a little bit of what you're doing differently today?
Definitely. Yeah. So I think the overwhelming answer is yes. But when I look at technology and efficiencies across the industry, I think it's twofold. I think it's the external technology that most issuers are familiar with, that investment button, that portal that you're raising capital through, or the technology that's guiding you through that transaction. That's something we're hyper-focused on, whether it's a single offering, perpetual offerings, or building an iOS app to support offerings. So that's something we're always optimizing and scaling. But I think when we look at the industry as a whole, where efficiency is really starting to pick up is across the different parties that support an issuer to go live for an offering. And so Sara mentioned, the relationship that Dalmore and Crowdcheck has. We work very closely together, and I think that's come through efficiency and operations and time and experience working with one another. There's CPAs, there's auditors involved, and eventually, and I think it's happening, but eventually, the cream of the crop will rise, and the best players will be there to support issuers. Now, there's always challenges, and sometimes it's cost, sometimes it's time. But I think when you have a team behind you that's efficient, that has experience, that's really where you're going to see improvements across the industry. The ability for an issuer to launch a CF in 4 to 6 weeks. Today, that's a sprint, but I think we're getting towards the point where issuers can move at a more rapid pace. Technology supporting that, automation supporting that. But the players that are getting an issuer to go live, that's the crux of it. And that's something where over time, efficiency will start to improve. And we're definitely there. I think the inception of the industry is one where we're all moving in different speeds to try and launch a company and support issuers. Now we're at a point where we have really, really strong mechanics to get an offering live.
So if I understand it correctly, Dalmore specifically, there's some services that you provide in-house when you enable a securities offering, a private securities offering, but at the same time, you partner with third parties like a Crowdcheck to provide, specific services as you look to create a portfolio of products to support and enable a company and its needs to access capital. Is that correct?
That's exactly right. I mean, there's several players involved to get an offering live. And what I stress to issuers is go with those who are experienced, go with those who have done this before, because they're going to know the nuances between the feasibility of using a CF for a very complex structure or not, and having to then leverage an A+ or a D, for example. So, from a tech stack, we can support an issuer, client facing, investor facing, and the ability to accept transactions. That's no problem. It's going to continually evolve and improve over time. But really where I think the industry needs to move towards is the efficiency across launching companies and removing or improving the barrier so that these issuers can access these different exemptions.
And Dalmore is one of multiple platforms that lets an issuer self-host effectively the promotion, but then all that information goes through your platform to be compliant in the process, which is interesting. What are some new features that you guys have recently incorporated? And I don't know if you want to share any, forthcoming updates.
Mm-hmm. Yeah, so on the tech side, our entire suite is built on an API. And what that allows for is rapid deployment of new features, new products, and new features for our issuers. Something that we're really excited about as of recently is our issuer dashboard. So the actual analytics and the actual details of your offering. So when you look at the landscape of raising capital online, there's the funding portal model where you're raising on a platform, sending your investors somewhere. Oftentimes there's minimal transparency into that activity. And then there's the self-hosted model that Dalmore supports. And with that comes the robust need for analytics, being able to see your funnel, the drop-off. How is the KYC report going? Do you have to touch that investor a few more times to get them across that finish line? And that's really the value of a self-hosted offering, is putting the whole control of your offering in your plate. Now there's more responsibility with that, but there's so much more control as well. So having an analytical dashboard, integration, Zapier connections, connecting to your CRM, that's crucial for success with an issuer. So that's something I'm really excited about.
Okay, so that's really helpful. It's really interesting. So Woodie, again, you come from a little bit different perspective. You do data, but you also do services. You're also working on a fund, so you're kind of neck deep in the industry. Are you seeing things improve, like the timing, the time frame from engaging with an individual and getting their money in and completing the securities offering? Is that something that you see?
Yeah, I mean, I see a lot of technology players coming in to help facilitate the marketing of these offerings. So that it's interesting to see how people are using technology to expand reach. But then there's other people that are using technology in different ways, like we did with the fund. Like our whole concept is how do you take all this data on all these companies that are out there, thousands of them now, that are raising money, and how do you sift through it to find the ones that are actionable? Then you start to partner with people that develop algorithms, and that are data science people. So it's interesting to see how they're coming into the space too, to bring more probably clarity to investors, so that it helps guide their investment decision as to where they need to be focused and what they should be looking at. And I think all this sort of plays together, and this is like the evolution that's happening here, where you've got front end technology stack, and then you've got technology that's coming in at different stages of the game that help people at where they are, investors.
Okay, all right. So I think I know the answer to this, but Stormer, you said that you can get a Reg CF up and running in 4 weeks tops.
No, I would say 6 to 8 weeks is the target. 4 weeks would be optimal.
Okay, Reg D, they're both notice filings, but Reg D and Reg CF. Reg D is immediate about, and then Reg A continues to be about the same. I'm going to ask. I'll start with you, Stormer. What are you seeing for timing for each of those?
Yeah, so across the 3 exemptions, and this is assuming the issuer is prepared from a corporate structure, share issuance, and their entity is ready to raise capital. And assuming that's the case, I would say a Reg CF is a 6 to 8 week launch period. I would say a Reg D would be a week to 10 days. Now, the component there is oftentimes there's technology hurdles, leveraging different payment providers have diligence process as well. And so, I would say 30 days and you have a live offering with technology included in the full tech suite. And then Reg A, that's a challenging one because it can span anywhere from 3 to 6 months, and some issuers, unfortunately, beyond that. The complexity behind a Reg A oftentimes revolves in feedback from regulators and then implementing and revising your draft 1A. So it can span dramatically. That goes full circle as to why some of these Reg A issuers are looking at CF as a quicker go-to-market, a leaner go-to-market, while they're preparing for the larger A+.
Sara, thoughts?
Yeah, no, it's pretty much the same. I mean, the thing about Reg A is because you've got to go through the SEC, that changes everything. Now, we back in the pandemic days, we were seeing a lot of no reviews from the SEC. I mean, they'd look at it, go, okay, we've seen the law firm before, we've seen the accountants before, we've seen the broker before, go, we're not going to make comments. They have generally hugely slowed down, if not stopped doing that. The reason they were doing it is because they were so busy on SPACs and IPOs, not an issue right now. And so the SEC is still the sort of the major block there. Where we do see things go through really easily with the SEC is doing the same thing the same way. So if you're doing a fractionalized asset and you're doing it with the same documentation that the particular branch in the SEC has seen before, then you are going to go through pretty fast. If you are doing something more difficult, like crypto, even mentioning crypto, you are going to have a longer time going through the SEC. I mean, the fastest we've ever got anyone through a Reg A, and I don't think we'd ever replicate this ever again, but back in pandemic, 60 days from go to qualification.
Wow.
And that's from the very first. That's never going to happen again. And the longest one we've ever seen is 3 years, because
Oh my God.
crypto had huge crypto accounting issues. So that's the sort of the time frame for Reg A. One thing I would add to what Stormer said about Reg D is if you are doing the D alongside the CF, the D should really just sort of piggyback. You don't want to give different investors different disclosures. So the D investors get either the same or some variation of the disclosure that the Reg CF investors get. But otherwise, D can be, really fast. I mean, the only rule is with 506C, sell to accredited investors only, and do not violate the securities laws by telling lies. You do not have to have any disclosure at all. You can do it on the back of an envelope. Don't advise it, but legally you can.
It happens. Woody, do you have anything to add there?
No, I mean, I hear what both of them are saying. I've worked with clients. I've gone through the Reg CF offering. I tell people, you should expect to take 3 months to put everything together. It's, you've got bits and pieces that just entrepreneurs aren't aware of. I know that these Reg A it's a hairy beast. And that's why Sara is great to have around. But none of this is overnight. Just throw a net out there and go fishing and catch a bunch of fish. There's structure that you sort of need to follow. Even best practices would dictate that your investors need to have information to make an informed decision. So spend the time.
Okay. All right. I want to shift gears a little bit here now because there's some trends in the industry that have started some time ago, but I think they continue to develop and grow. And we're seeing more novel approaches, as the three of you have discussed. We're seeing fractionalization. We're seeing collectibles. We're seeing not just early stage offerings, but mature firms. We're seeing more debt. And I think all of this is good for the industry because people, issuers firms, more mature firms are seeing these online securities exemptions as a viable path to raise money they need. And I'm going to start with you, Stormer, because you guys have really been one of the champions of fractionalization and collectibles. We talked about, you know, a racing horse early on. You guys actually powered a Derby winner. I can't remember which one it was, but you guys have been big in creating, not taking assets and creating novel securities. Is that continuing to evolve and develop? Is that a big part of your business? Will it be for 2024?
Absolutely. Yeah, absolutely. And you hit it on the head in that, you know, we do work with a good portion of the fractional platforms in the US. And what we see is increased appetite for alternative assets. I think that echoes down from institutions, the desire to have various alts rolled up into IRAs, into brokerage accounts, and have more liquidity around the industry. But we definitely see an increased appetite around the idea of fractionalizing different hard or soft assets. I think what we've found is you see a lot of great examples of platforms out there. You may see our name mentioned in the disclaimer, and then issuers will come to us and say, hey, we want to do what they're doing. How do we go about that? And that's really where we've had the luxury of supporting and guiding some of these issuers. Now, what comes of that, though, is the issuer educating and learning about what these exemptions allow for. And just because one entity or one platform is doing something related to real estate doesn't necessarily mean you can do that exact structure, but as a fix and flip or as some type of other, you know, traditional fundraising mechanism. So I do see, you know, significant increased volume for the platform model, being we want to host multiple offerings, CF, A, and B, and we want to then take our existing portfolio of assets and start offering them to the crowd. And what that will allow for is scalability for us as a firm to go acquire more assets, but it also gives the ability for more liquidity and more exit opportunity for investors. If these assets do have demand, there will be exit opportunities in the future, positive or negative, which will result in returns being paid back to investors. And that platform and that fractional model is one that I see a lot of validity in the future, as opposed to the seed stage CF, where there's a 7 to 10 year horizon, extremely high risk. And that should be known to investors. The platform model has an opportunity for some income, dividend, or distribution, which I find really appealing.
So what percentage of the issuers that you're working with are not early stage? Now, I mean, this is kind of, everything was early stage for a while. Now it's like just a new world. It's an entire new universe.
Yeah, I mean, challenging question to answer. I mean, I think when you look at the universe of fractional platforms, there may be 80 or so in the US. I would like to say we're involved in over half of those. And in the Reg A space specifically, you know, King's Crowd tracking the industry, I believe we're participating in about 58% of those filings. So we do really see a variety of offering structures. We see a lot of different platform approaches and many that are going to be launching in the near future. And so it's hard to give you a percentage, you know, exactly. We've been very focused on Reg A. Reg A typically gravitates toward the more mature type of issuer, and those that then leverage the exemption on a perpetual basis, perhaps in a series model as well, issuing, you know, several assets within one Reg A structure.
Yeah, I like the entire transition to more mature, to providing income instead of just, you know, capital gains, you know, giving more choice for investors in the private securities markets. Woodie, you and I were just talking the other day, and you kind of shared a potential customer that was doing something really unique. You know, maybe if you're willing to share it, maybe you can share what they were attempting to do. And I don't believe they were able to do, or maybe it's still in process. Do you want to share that? I thought it was really interesting.
Yes, so a Venezuelan company, so we'll just start with, okay, Venezuela, okay, questionable. But a group of farmers raise cattle, and revenue share is how they distribute the income from the cattle that are raised. And they have Venezuelan investors in Florida that invest in these cattle and receive distribution when the cattle is sold off. And so they want to streamline the process by bringing technology to it. And they wanted to build an online investment platform, register here in the United States, so that they could then have their U.S. investors invest in the cattle in Venezuela and bring in more Venezuelan American investors. So, you know, there's a lot of questions that come up with that, but it's just showing you how people are thinking about what can you do with this exemption. What can you do with the technology? How far can you push it? You know, all of these platforms need to be registered, so you know they'd have to get through FINRA approval. But you know, it's interesting to see where it's, you know, the calls that we get are fascinating on this front.
Yeah, no, I mean, I think it's I don't know if that's viable or not. I have no idea, but I think it's fascinating to see that everything or anything can become a security today as long as you adhere to the existing securities law. Sara, I know you've seen some kind of probably, you know, very creative securities offerings or, you know, potential securities offerings. What are you seeing that people are trying to do today that's unique and novel and maybe is being approved and maybe it's not?
Yeah, I mean, one thing that I would note is with respect to the collectibles, now that the Reg CF limit is 5 million rather than 1, some of the folks who would have gone Reg A for their collectible series are trying to look at Reg CF. That does not necessarily work. It's much more problematic, you know, down with the with Reg CF, because Reg CF has some rules that Reg A doesn't, and then that includes what we call the issuer aggregation rule, which is you get treated as being the same issuer and subject to the same rules if you have you know, if you have a common control person, which could include a VC having a board member in company A and company B. Once that happens, company A and company B, for the purposes of Reg CF, are the same issuer. And that means that company A can suck up all of the allocations, leaving nothing for B. Doesn't happen in Regulation A. Similar sort of thing with series. Let's say you have hugely successful, like Fundrise style success in real estate in Reg A. You can set up another Reg A fund. You can't do that with Reg CF because you've got that 5 million across the board, across, you know, the sponsor would be a control person for both of the companies. And you run into that same issue with respect to the collectibles. So across the board, some of the things that people were doing Reg A for, and are now going, oh, maybe we can shift over to Reg CF. Not necessarily the case because the rules are different under the 2 exemptions.
And people want to use Reg A for secondary trading. You can't do that with Reg CF because there's the 1-year holding period.
Right.
That's true. Yeah.
That's
and Reg A securities are free trading. Reg CF securities, while not being technically restricted under the securities laws, they are restricted for a year. And that's one of those things that, you know, you've really got to be a securities lawyer to love explaining that. They're not restricted securities, but they're restricted.
Okay, that makes sense to me. Right. So okay. I'm going to ask another question here about venture capital. It's always been my opinion that if you could pair professional money with retail money, especially on the same terms, that would be good for the overall industry in general, because the professional money can be a leading indicator about deal quality. Everybody understands investing entails risks. You never get away from risk. It's just, you know, how the game goes. We're a market economy. But I believe Stormer, you mentioned this, and maybe Woodie, you mentioned this. You're seeing more VC participation in online capital formation that is engaging with retail. And I'm going to start with you, Woodie. Is that an accurate statement? Am I off base?
No, you're 100% right. I mean, boy, when we were in the earliest stages of this, every VC was just like, well, this is going to be the worst of the crop.
Yeah, right?
No wonder they're going to go to crowdfunding. And, you know, at the beginning, it wasn't the best quality. But what we also saw is the UK was way ahead of us in terms of getting started with this legislation, or investment crowdfunding. And the VCs were already investing in the deals over there when we were just getting started here. So they were sending the signal over there that that will be what happens here. And that's really what's playing out. I think at least 10% of the deals each month have some sort of VC participation going on. But I think, it's the VC participation. I think the VCs are also, I speak to a lot of them. They also look at crowdfunding or regulation crowdfunding as, a barometer now. Like, have you gone out to Reg CF? Have you raised money from your community? What milestones did you set for that? Did you hit those milestones? How accountable were you with the capital that you raised from the crowd? So they want to, they're using this now as a vetting mechanism to see, like, have you done this step now? So it's interesting to see the evolution has gone from, self-funded to here's a, branch of trust going out to a group of people that are my community. I need you to do this marketing and then brand advocacy, bring people in for sales and all that to help us grow. We can do it instead of I can do it mentality, to then moving on to VCs now, which is always the jump that had to happen, where VCs can be like, okay, we're going to use our dollars and our Rolodex to get you to the next level. So it's sort of merging, and but it's fascinating to watch this evolution happen.
Yeah, and you've seen some Reg D platforms that have kind of always done that. You see, like, an R Crowd, which goes and participates in a funding round, and then they turn around and they sell that, almost all of it, to smaller investors, but you have to be accredited. And what I'm hearing you say is you're starting to see that, like, merge into the more retail structure. And Stormer, I know you guys are looking at this, working on this. You've had inquiries on this. Can you share what you're seeing today in regards to partnering with venture money and venture participation?
Absolutely. So I would extend it even into the accelerator world as well. I've mentioned the increased appetite from more sophisticated investors, and I think you could call the VCs and accelerators in the same realm. And what we're seeing is the idea around opening up their portfolio to larger communities. We have tier 2, tier 1 VC firms that have exponential followings that are typically leading rounds, and see an opportunity to bolt on retail investors to those offerings. I would love to see a scenario in the future where you see a portfolio online for a VC and you have the ability to invest alongside that VC concurrently. Yes. I think that will exist in the future. Now, I even see unique structures where accelerators are looking at their portfolio and saying, look, we want to continue to invest in you, but we want to see you hit certain milestones. And one of those milestones that have been proposed is, a certain minimum invested through the crowd. Can you get your customers excited about your business? And if so, there's an opportunity for a bolt-on investment from the accelerator. And, that is, I think, really interesting. It's I think, mutually beneficial, because you're bringing, an early stage company, garnering community, bringing them in as stakeholders, and then getting a larger injection from an institution. And that, I think, is really appealing.
Yeah, I think it's totally appealing. And recently I was having a conversation with one of the largest angel groups in the country, where they were taking a look at the technology and the opportunity with these online securities exemptions. And Woodie, you said in the beginning, everybody was like, oh, that's just going to be garbage offerings. But I think as that hasn't become true, that they were seeing quality issuers, and not everything's going to be a home run, but you're seeing the industry morph and evolve, that it is opening up doors to creative partnerships and opportunity that's beneficial to all. So I like what I hear coming out of Dalmore. Sara, you see all. I mean, what are your thoughts on our participating, alongside, VC capital, venture capital?
Yeah, we have seen a huge shift. I mean, originally, the idea was, venture capitalists were like, we do not want retail investors anywhere on the cap table, and so there was always this this crazy idea that somehow if you could do an SPV and put them in the SPV, then they wouldn't be on the cap table. They're still on the cap table. They're just on a different cap table, and you've still got to manage it. But that may have addressed some of the VCs' concerns. But a lot of the VCs were just, we don't like retail investors. We do not want to be involved with them. They're complicated. There is some reality to that, because when there is an acquisition event, so let's say it's high growth company, tech company of some kind, and now another company wants to acquire it, another private company. That other acquirer is going to have to take on all of the retail investors. And you've got a couple of issues there, which is, if the retail investors have, under state law, any say in whether they get taken along or not, that is deemed to be an offer of securities. That is an investment decision. It's under Rule 415. It is sorry, Rule 145. It is it's a securities transaction, and therefore that transaction itself has to meet the requirements of one of the exemptions. If the private company is if they've got a lot of money, then they can do a Reg A. They're probably, if there's been any success at all of the acquiree company, then Reg CF's not going to help, because you've got the $5 million limit. So that's another reason why VCs might legitimately be leery of crowdfunding, is what happens in the future when a big acquirer wants to take us over. But we have seen much less of this, oh my God, we hate retail investors, over the years. VCs have got a lot more comfortable with, hey, look, if you can't sell to your own customers, why would we invest in you?
Yeah,
But
right.
we're still seeing
Yeah.
it. I had a lovely company recently. They did a Reg CF. And a lot of interest, high growth, high tech company, and the whole thing got pulled because big investor didn't want retail investors, and that happened only a few weeks ago.
Yeah.
So it's still
Yeah.
happening.
I think that the regulators, the policymakers, should be looking to make the best deals available to the smallest investors. I think that should be a policy approach, as opposed to trying to keep out retail from some of the best opportunities in the marketplace. So very quickly, because I want to get to a few of these questions, I wanted to ask about secondary trading. This is something I love to talk about. I think it's something that needs to happen. It hasn't really happened very quickly in the United States. It's done better in the United States. There are challenges here. There are regulatory challenges here. I am frustrated because it's been so slow. I'm going to start with you, Woody, because I know you have a company that helps to enable this, called Guard. But is this something that's going to happen? Are we ever going to get there, or is the hurdle just too big?
Well, I mean, when it comes to secondary trading, you either have to register your securities in all the states in which they're offered and sold, or you have to find an exemption from registration. And the manual exemption sort of allows issuers to get coverage in 42-ish states, so that they don't have to file in all those states, but you have to file these ongoing disclosures so investors are informed. And that's what Guard does, is we really take in that information and publish it into Merchants National Securities Manual, so that these issuers are compliant. And then we help them with California and New York, so that in theory, you can have trading in all 50 states. I feel like, when I talk to the other players as well, the platforms, the ATSs, that the technology's really built, the plumbing's there. We're just waiting for the water to start coming through, the volume. But we're seeing it. We started with one security, and now we've got 700 plus securities that we've done compliance for that way. So it's happening. It's just nothing happens overnight. Everything's slow, and we talked about
slow.
this. This is a tough place to be in right now, because you have to hold on to your cash. If you've one of these platforms and you've built this, you've got to balance how long can I hold out until the market gets to where I need to be with running out of cash and going out of business. So
yeah, Stormer, it's not there yet. Stormer, are you guys doing anything with secondary transactions, or is it something that's on your roadmap?
No, it's very much ingrained in our process with certain issuers. And I think secondary has to be a part of your core strategy. It's not for every type of issuer, but it has to be designed and built into your overall strategy. So going back to the platforms and the perpetual issuers, we have many platforms doing hundreds or thousands of trades a month. That's happening within their own domain, and that domain is their community. And so it's this constant battle of supply and demand. The issuer wants liquidity, but there has to be recipients on the other end for a bid and an ask. And that's something that's challenging when you're starting out and you're building your audience around your venture. So secondary, definitely top of mind. I do see there being, increased volume as the industry matures. I see a future where these alternative assets will roll up into these larger brokerage accounts, be it Robinhood, eToro, Fidelities of the world. That there's an appetite for that.
I agree with you, and I think that needs to happen, but we have problems right now because you can't get the shares into a brokerage account because of this and that, right? Am I wrong, Sara?
No, that's absolutely right. I mean, most brokerages will not take certainly these alternatives, and some of them won't take private securities at all. I know mine won't. And that's a problem not just for secondary trading, but for eventually getting listed when companies move up and become listed on NASDAQ or NYSE. When that happens, usually there's a little bump, and everybody who is desperately holding their securities through transfer agent A, trying to get them onto transfer agent B, who is a member of DTC, and make them DTC eligible, they're losing out, and by that time the value of the shares may have gone down and they've missed the moment. But I think the biggest thing, if you'll permit me to say this with respect to the secondary market, is the secondary market is never going to be successful until issuers get realistic with the valuation of the securities in the first place. Because one of the things a lot of issuers are terrified of is having the secondary market set the price. And this is the SEC's view, is the market sets the price. Well, if you went out and you did a Reg A at $10 a share, and then you permit secondary trading, and then the market's like, yeah, no, not 10, 2. Now all the issuers look at the other issuers who did that and go, well, I'm not doing that. And of course, the answer is set the price correctly in the first place.
Yeah, I agree. Okay, so I'm going to go to some of the questions here because we only have a few more minutes. I'm going to see what's in the chat here. But the secondary thing I think is very important because you want to provide a path beyond an M&A or an IPO, and it just needs to materialize. Let's see.
While you're looking at I'll just toss in there that Sara's point is so spot on for primary issuance too. Like, when we look at a lot of these deals where the valuations for these Reg C offerings do not match your revenues. Like, just because you're raising money through this exemption Reg CF doesn't mean you can have an insane valuation. There's logic that applies to how much your company's worth. And if you go outside of those parameters, we're going to ask the question. Some other sophisticated investors going to hopefully ask the question, but you're going to have to justify it. So people need to spend more time being rational about what their company's really worth.
I agree. So somebody asked a question about fraud. I know it's a touchy subject because fraud exists. It always exists. Fraudsters are going to fraud, to quote Sara on this. You can't misconstrue that with failure. Sometimes those lines are a little bit blurry. But Sara, I know you have a strong opinion on this. What type of levels of fraud are you seeing in the, I'd say, A plus and CF market?
I mean, to go to the standard definition of fraud is it material a misstatement of a material fact. And we see that a lot. What we also see is the flip side of that, which is an omission. And to go through the actual definition, the omission of a fact necessary to make what you already said not misleading. So, typical example is we have 2 factories. Great. But the misleading omission is, but one of them just burned down. And that's, we see this sort of half truths being disclosed all the time. We try and stay on top of that. As we all know, entrepreneurs just by their nature are just so optimistic. And that's great. But there is a huge difference between we are the greatest muffin makers this side of the Mississippi, and we have 16 franchises when you actually only have 2, but you're working on the others. So it will be true at some point in the future. So
Maybe.
Yeah. So that is fraud. We do see sometimes the actual running away with the money. One of the distressing things that I've found there is when we do identify those things and try and flag it to regulators, nothing happens. So there's no publicity to it, and there's no sort of corrective effect on everybody else. I would like to see the regulators be more robust, but there's the actions they bring now are for things that happened in 2016, 2017. So there's always this very long lag.
There's a delayed reception. Yeah. Stormer, a question for you. Are you seeing issuers that will use Reg CF to get to a Reg A?
All the time. I mean, we talked about it earlier. 6 months to launch a Reg A, significant upfront costs. If your structure allows for a CF, why not raise the first 5 million and prove that you can raise the capital from the crowd as you're preparing for an A? I encourage it. I think it's a great model.
Yeah, I agree. This is more of a statement, and I think I know who's asking this, but I agree with it. I'm going to ask what you all's thoughts are on this. Should the SEC remove the requirements to have reviewed financials for amounts below 1 million under CF? Woody? Is that a yes or no?
I don't know if you can hear me.
I can hear you. That's all that counts. All right. We'll go Sara.
Yeah, I would think that's a good idea in some circumstances, like as of inception numbers, how useful are they? They're really not the numbers for SPVs, but for operating companies, no, I want to keep them because I read those things.
Right, like Form CAR. Stormer?
I would echo what Sara said.
Yeah. Hey, I'm not sure if there's a good answer for this. How do FINRA-approved platforms work with broker dealers on fee sharing? There's some nuance there. Stormer, maybe you can help me out there?
Sure. Yeah. So fee sharing is complex and really only reserved for a broker dealer. We do have scenarios where we have registered reps of a platform or of a business that is licensed by Dalmore, which allows for commission sharing. So that is an incredible strategy that we've seen work for really high volume issuers. Aside from that, it's really on the onus of the platform to come up with an economic model that makes sense and is not based on the sale of securities.
There's a question from somebody outside the U.S. They wanted to know if a German company can raise money in the U.S. And I'm going to ask you, Sara.
They can easily if they use Reg D, accredited only. With respect to using either of the other exemptions, the rules are slightly different for CF and A. In general, you got to be here. For CF, you have to be incorporated here. And if you were just using the US incorporated entity as a finance, flow through as a financing sub, that wouldn't work because the German company would be the quote real issuer there. So in general, and if you look on the Crowdcheck blog and search under foreign, you will find the much more detailed answer.
I think there's been 14.
There you have it.
There's been 14 companies international companies that have used Reg CF to raise money, but not very successfully. they've all incorporated here.
Okay. All right. I think on that note, we're going to call a stop to this, although I'd like to continue. First of all, I'd like to thank my experts here, Sherwood, Neiss, Woodie, Sara Hanks, the two OGs, and Stormer with Dalmore Group, one of the most active broker-dealers in the industry. You guys are awesome. I want to thank everybody who has joined us today, and for those who, of course, join us on when we post it on our website. We really appreciate your participation. If anybody who's watching this today has any further questions or suggestions, you can reach out to myself or anybody who's participating in this panel. And thank you very much for attending today. We will be doing another webinar at the end of this month on May 30th about community development, and we hope to see everybody then. So please have a great day and the rest of the week. Take care.
Thanks, Andrew. Thanks all.
Bye.